Let's move on then. Vinay Jaising is MD and Portfolio Management Services at GM Financial, who's now joining us. Vinay, good afternoon. Thanks a lot for joining us. How are you reading the current market rally? It's been a very sharp one, and a lot of people have missed out on this. You reckon it still is some kind of a counter trend rally, or are we in a fresh bull market?
So, our belief is we are just about 8% below the peak of the market. In the last month, the Indian market has moved up by more than 5%, and at the same time, China has actually fallen by 8%. So the outperformance is immense, as much as 13% compared to China and 5% compared to the rest of the world. If I look at it over the last year, India over China has been almost 28 to 30%. So I think the outperformance has been substantial. That kind of tells you India is in a very sweet macro situation, but it also tells you that relatively, based on what Fed is doing, based on what interest rates are moving around the world, it's time to be a little more cautious. And this seems to me to be a rally just because the markets corrected significantly, and the markets are moving up thereafter. We would be very concerned on the market because the multiple the market is having on a one-year forward basis is almost 20, which is a little bit premium to the 5-year average and about 15 to 20% premium to the last 10-year average. So we think there are downsides to the market in the short term.
Hi Vinay, what are the chances that we go ahead and visit the recent lows? Let's correct by another 10% from here on. Do you think the chances are relatively high? Point number one. And the other factor is, I think you're sitting on cash of close to around 15-16%, or that's come down to around 10%. Where have you deployed that money?
So, very clearly we believe the primer comment that you made, which is the market could go back to 15,000, 15,400 levels. And remember, the QT has just started. This is the first month wherein you saw over $35 billion being taken out by the system in US, most of it in the last 2 to 3 weeks. It has to be $47.5 billion for next year, next month. And come September, we're talking about twice that amount of tightening, which is about $95 billion on a month-on-month basis. So liquidity going out of the system is not very good news for the equity markets. So we are certainly concerned in the next 3 months. Having said that, we got a whiff of the credit growth being very, very strong in the Indian markets for the banks. So out of 15% of our weightage, we increased our weightage on banks pre-results by about 5%. So yes, we are sitting with cash, but we reduced it from 15 to 10. And we are smiling because, the bank results have shown a 60% of EBITDA, net profit growth on the back of most of the private banks having 18 to 20% loan book growth. So great set of numbers coming in from banks, and we are in it.
Vinay, hi, afternoon. We've been kind of riding the global, the themes have been largely all global, right? Global liquidity, more of it, less of it, Fed rate hike, no rate hike, lesser, more. What about the underlying sort of strength of the consumer here? Very little focus on that recently. What do the numbers tell us? What is your own sense? Because it'll come down to earnings here, domestic earnings as well.
So let's break this question up into two. Let's look at the current earnings very quickly, and then go on to what domestic themes we are playing in. As far as the current earnings are concerned, there are about 180 plus companies which have reported earnings. The top line is pretty decent. The net profit growth is 25% on a year-on-year basis, very similar to a 3-year CAGR. But if you take out the banks, that 60% number which I gave you, and then you see the results on a YOY basis, net of banks, you're just up 6 to 8%, and margins are down. So that's the starting point. Having said that, I think what's also happened is commodity prices, most of industrials are down between 15 and 30%, which means sectors which have raw material as industrials may have some inventory losses in the immediate term. But because they have demand of over a quarter on their books, if you look at auto sector especially, as well as the capex sector, which people have forgotten in the past. Both these sectors, I think, are telling you that India is very resilient and the growth is very strong. So these are two spaces we think non-global, very big positive as far as India is concerned. So these are two themes we will be playing.
Okay. Vinay, what did you make of the market's reaction to names like Bajaj Finance? The stock's up 31% this month.
Well, the valuations, the company's results were fantastic. So let's just start by saying this. You had IPO financing happening last year, which vanished here, but the results have come out very, very strong. There are big time people who like these as stalwarts. But I think the market reaction has been a lot more positive for some of the NBFCs. We have an underweight recommendation for NBFCs in our overall portfolio. We prefer banks over NBFCs.
Okay. All right. You're also not too positive on some of those IT names. The numbers as well, though there has been revenue growth, the margins have been a little bit disappointing. The worst of attrition as well. Maybe it's not behind us. Your view on the stock, say they correct another 10% from here on. Would that make you change your mind, or your view? Yeah.
You look at the amount of outflow which has happened in the last 6 months, and you try to break that up into which sectors that the outflow happened. It's largely financials and IT. In the financial space, what you're seeing is the earnings is real. An interest rate increasing environment makes you see that NIM can be a lot more positive. OPEX ratios should be in control. And the capex, as I mentioned, should be increasing. So that's the space where we can take an advantage because outflows have led to some corrections in some of the big financials. Put the other way around in IT, what our analyst believes is if US slows down, the growth rate, whatever you were talking about for this year and next, this year you have a lot more visibility on the growth rate, but the order book is not as appealing as it should be for next year. So if you get 10 to 11% growth in fiscal 24, you'll be lucky. But the question is, the staff costs are going up so much. Isn't it a time where margins are coming down as well? As a result of which the P, for the top bigs in the sector is between 20 and 24, 1 year forward, which is largely in line with the 5-year averages. So, we're quite content being relatively underweight in this space, but we like the big names.
You want specialty chemicals for a while, Vinay? What's changing there? What's happening now, currently?
So we still own specialty chemicals. That's one of our overweight positions as well. It's a mixed bag, if you ask me. Some of the results are still to come. One of them was rather disappointing because of the supply chain, largely in injectables. Having said that, most of the other results are okay. Where we are excited about is the dollar is today at 80 versus the rupee. And these people, because of contract manufacturing, have got long-term dated contracts. And if you go down the chain to fine chemicals or APIs, wherein you've got a couple of producers just producing them for the world for between 10 and 30% of the overall market, you start getting a little excited out there. So we're still bullish in that space.
All right.
One we would like to play. Sure.
Okay. Okay. All right. Vinay, always good hearing your thoughts. I think you're a little bit under the weather, but thanks so much for joining in fact, giving us your view on markets and a whole host of sectors as well. By the way, when we're having that chat with Vinay, the markets have again taken that leg up, and I think a couple of these heavyweights, Reliance Industries, that's